Hello and welcome to Accounting 201, and today we're going to look at a demonstration problem for accounting for uncollectible accounts. So I'm going to read the problem and then I'm going to switch to my work paper. And again, you have this problem available to you on Blackboard if you would like to have that available as I'm going through the problem. That way I'm not switching back and forth between screens. So the solo company was started on January 1st of year one. The following events occurred during year one and year two. So for year one, we provided $4,000 of services on account. Year two, collected cash from the accounts receivable. And year three, you estimated an uncollectible accounts expense. Year two, you wrote off accounts receivable that were deemed uncollectible. You performed more services on the account. You also collected cash to pay down accounts receivable. And you received $5 from an uncollectible account that had previously been written off, and therefore you reinstated the account. 5, you recorded $5 cash received from the receivable that was reinstated in event 4. And then 6, you also updated your uncollectible accounts expense. So we're going to record these events using the horizontal financial statement model. And again, just like we've been doing the whole time, you can actually take this information and prepare the full financial statements. But in the interest of saving time, that's why I'm not doing that. So the very first thing that we're going to do is provide $4,000 of services on accounts. So you can see here, make sure this is working. You can see here that we have cash plus net realizable value equals liabilities plus stockholders' equity, specifically retained earnings. So here's what we know. When you're looking on a balance sheet, we know that we have cash listed, and we typically see accounts receivable listed next. And then something that you might see after that is allowance for doubtful accounts, okay? That's what we call a contra asset. So contra means opposite. And so what that means is when this account, so this is a contra asset, when this account is sitting next to an asset, you net these two accounts. So let's say the total amount of accounts receivable is $1,000, but we've identified that $200 would not be collected or collectible. So what we're saying is that we think, even though we have $1,000 outstanding to us, we think that 200 of it is not going to be collected. Therefore, our net realizable value is $800 for those particular accounts. So it's important for us to be conservative in our financial statements. We want to make sure that we are letting people know how much we actually think we're going to be able to collect. And so that's why you're going to see me calculate a bad debt expense or an uncollectible accounts expense. That's the same account. So just to let you know, in case if you hear me say bad debt expense or allowance for doubtful accounts, those are the same accounts that your current textbook talks about. It's just I'm used to saying bad debt expense. It's a lot easier to say than uncollectible account expense. All right, so we provided $4,000 services on account. Now, because this is accrual accounting, we are able to increase our retained earnings by $4,000, which increases our revenue, right? And we can go ahead and record this because we actually perform the services. So I'm going to show that our accounts receivable under net realizable value, like I talked about up here. So there's net realizable value. So accounts receivable plus allowance for doubtful accounts will help us calculate the net realizable value. So $4,000 can be recorded. That's owed to us because we actually perform the services. So that increases our net income by $4,000. But what that does not do is affect our cash flow. We didn't receive any cash. So notice there's no cash. No cash flow. 2, collected $3,000 cash from accounts receivable. So we can see that a cash increase shows here. That means that somewhere down the line, people paid off their accounts receivable, okay? That does not affect our income statement because, again, this particular $3,000 that we collected, that was actually recorded when the services were performed. But we do see a $3,000 increase in operating activities because cash was actually collected. And then 3, we see that estimated uncollectible accounts expense for this bad debt expense to be 1.5% of the credit sales. So 1.5% of $4,000 is $60. So what I'm going to do is I'm going to call that bad debt expense or allowance for doubtful accounts. That is going to reduce this net realizable value. So just like I talked about up here, accounts receivable less the allowance or bad debt expense, you're going to calculate the net realizable value. So you're going to see that decrease. You're also going to see a decrease in your retained earnings by way of bad debt expense or uncollectible accounts expense. You're going to see that there and see that there. That, again, does not affect cash flow. So you can see if you add 0 plus 3,000, you're going to have an ending balance of 3,000 for cash. Your net realizable value for your accounts receivable would be 0 plus additional $4,000 in accounts receivable, less pay down of $3,000, less us calculating how much we think we're not going to be able to calculate, which would be $940, which again, that's basically this calculation that I have right here. So the accounts receivable would be $4,000 less $3,000 or $1,000, less the 60 for the bad debt. That's my allowance for doubtful accounts. I'm going to have a net realizable value of $940. Your net income is $4,000 less the bad debt expense, or $3,940, and then we have a net change in cash of $3,000. So I'm going to move on to year 2. Year 2, you wrote off $40 of accounts receivable that were deemed uncollectible. So of that 60 that you set aside, that you basically set aside that in a bucket, you've actually identified who in the world those particular bad accounts are. But here's the thing. Whenever you're recording this write-off of accounts receivable, basically you are reducing the amount of bad debt, the allowance for bad debts. So we don't mess with the expense per se, but that contra account that I was talking about, that allowance for doubtful accounts, it shows right underneath the accounts receivable. So remember, accounts receivable less the allowance for doubtful accounts, that equals the net realizable value. Okay. Well, if in this allowance for doubtful accounts, remember we have a balance of $60, and at this time our it was $940. No, that was $940. This was $1,000. Okay, so within this $40, within this amount, or within the $60, sorry, within that $60, we've identified that 40 of it is for sure not collectible. They've been outstanding for so long now. Companies have policies about this. So we've identified that amount will not be collected. So the thing about that is that does not affect our cash, okay? Therefore, cash flows would not be affected. That does not affect anything on our income statement because we've already recorded, when we recorded this 60, we actually recorded it up here in this transaction 3, okay? That's where that 60 came in. So we don't need to record any other expenses, but what is interesting is we're going to decrease this allowance for doubtful accounts. Remember, this is a contra asset, so it's opposite. So when this decreases, we're also going to decrease the accounts receivable, which has a net effect. So if you decrease the accounts receivable and you identify in the allowance for doubtful accounts the $40, that's actually going to have a net effect on your net realizable value of 0. So we're not going to perform any sort of write-off here because this writing off an accounts receivable decreases the accounts receivable account and the corresponding contra asset account, that allowance for doubtful accounts. Therefore, the total amount of assets is not affected. The total amount of assets is not affected, so there's nothing to do there. 2, you provided $6,500 of services on account, so you're going to see an increase in accounts receivable here, and an increase in retained earnings for revenue, an increase in revenue, an increase in net income, but no cash effect there. 3, you receive $5,400. So just like we did before, we're going to increase our cash. We're going to decrease our accounts receivable. This does not have any effect on the income statement, but what you will see is increase in cash for operating activities over here in step 3. 4, somebody came in and they paid $5 from an uncollectible account that you had previously written off. So you've written this account off. I'm going to take their $5, of course. I'm going to take their $5, but what I'm going to do is recover their accounts receivable. So recovery of an accounts receivable increases their accounts receivable account. It increases the accounts receivable account, but it also decreases the allowance for doubtful accounts. So you can see here, 5 plus a -5 would be 0. Okay, so we find that there's no change in assets whenever we're recovering accounts receivable account, because again, that recovery, I'm putting that accounts receivable back on the books so I can decrease the accounts receivable again. So I'm putting it back on the books, but removing it from the allowance for doubtful accounts, which is again a contra asset, and contra means opposite. So what that means is the accounts receivable acts, when the accounts receivable increases and decreases, that allowance for doubtful accounts acts exactly the opposite. So what might increase the accounts receivable would decrease the contra asset allowance for doubtful accounts. Again, just by reinstating the account, there's nothing on the income statement, and then the cash flow would not be affected. So again, this basically, I can draw lines through. Recovery would have a wash effect, or a zero net effect on the financial statements. But 5, I'm going to actually record that $5 cash. Then I'm going to show a decrease in the accounts receivable because I reinstated it in number 4. And then I'm going to show an increase in operating activities here for $5. There is no increase in retained earnings or an increase in net income, because that service would have been recorded at the time that it was actually performed, not when we received the cash. And number 6, here we go again, estimating uncollectible accounts to be 1% of year 2 credit sales. And so 1% of year 2 credit sales are $6,500 times 1% would be $65. So that's a decrease. That's a decrease in the allowance for doubtful accounts would decrease that net realizable value. So remember right here, allowance for doubtful accounts decreases it. That would also be a decrease in retained earnings, because a bad debt expense or an uncollectible account expense actually decreases retained earnings. It also decreases net income. Okay, but has zero cash effect on the cash flow statement. So you can do the math all the way down here to get your ending balances, like we've done the past 7 chapters, and see your net change in cash of $5,405. Please let me know if you have any questions about this. The allowance for doubtful accounts can get a little bit tricky. The estimated expense of 1% of year 2 credit sales, or 1.5% expense of year 1 credit sales, that's all information that has to be given. That wouldn't be something that you would have to calculate. As an accountant, you would calculate that in practice, because you would look at your historical cash sales and then come up with a good number to identify how much of that you actually think that you're not going to collect. It's not very conservative to report the full or 100% of the accounts receivable that you have owed to you, because most likely people will not pay you. Now, whenever you're going through and you're actually giving credit sales, and I'm sure you read this in your textbook, you want to be careful who you extend credit to. And so not everybody gets credit, right? Just like not everybody should have a credit card. Not everybody has a high credit limit. Some people have a low credit limit. And so that's different based on your past credit history and your banking history. And so whenever you're setting up an account with somebody, you would look up all that information. Of course, you would get their permission to talk with their banker, look at their credit report history as a company, and try to see if your company wants to extend credit. Now, here's the problem. When you extend credit, what that does is that might increase your sales, because some people may not come to you in the event that you do not have credit terms. If you require that they pay cash today, they may say, oh, well, I'll just go to your competitor because they allow me to pay in 30 days or 60 days or whatever it is. But the problem is that the longer that this account is outstanding, the less likely it is that they're actually going to pay you. So somebody who has an account that's 30 days past due is more likely to pay you than someone who has an account outstanding 60 days or 90 days. And so by the time it gets to 90 days, you might decide that you need to write it off, which is what exactly happened in year 2, event 1. So you wrote off $40 of accounts receivable that you deemed uncollectible. So we always plan for that. So, we calculated what percentage of sales we think is going to be uncollectible, but then at some point we look at the actual uncollectible accounts and name them by name and say, you know what, this one's been outstanding for too long. It's time for me to write it off. It's time for me to actually decrease my accounts receivable. And so that's what we did. Now, again, this particular approach to accounting does not have debits and credits. We're not looking at debits and credits here. But if you were to be looking at the debits and credits for this journal entries, you would see that there would be a decrease in accounts receivable. And then you would have to reinstate that account with an increase in accounts receivable if we were talking debits and credits. But when you're looking at the net effect on this horizontal financial statement model, which is what we are doing in this particular class, it's just one way to teach accounting to students, especially students that are non-accounting majors. Debits and credits tend to scare students, but you'll find me, I always think in debits and credits because I am an accountant. And so one of the things that I think of is that this account actually would decrease whenever we're talking about journal entries. So if you have any questions about that, please let me know. I'd be more than happy to talk with you and find out what your particular questions are.